Hey traders, Raghee here, and in this free recap video, we're going to cover a trade that we took into the close, but I want to walk you through a really important lesson that I think will serve you well, especially for those of you that love trading trends and struggle to understand when to look for a retracement or when momentum might kick in. And really, not that it's a matter of knowing which it's going to be, but it's a matter of understanding risk reward and how to position yourself in a trade that's going to give you the largest reward and obviously the most minimal risk. So focus on these two center charts here. Now the layout that you're looking at right now is a very typical layout for me when I'm in the chat room and we're doing specifically futures index trades. So you'll notice I've got the Dow here, the S&P, the NAS, and the Russell. Now, let me mention something. Russell does its own thing. It's fine to put it here, but Russell absolutely does its own thing. And then we have the S&P, which kind of acts a little bit like the Dow, obviously has weighting a little bit like the NAS. So you kind of think of this one sort of serving two masters. I mean, you've got the Dow and the financial emphasis on this contract, and then you've got the tech emphasis on this contract. And if you look at the first four names in the S&P, they look a lot like the NAS, right? You've got your Apple, Microsoft, Amazon, Facebook, right? So we know it can act like either one. Now here's my rule of thumb. Here's the first rule that I think will serve you really well for the remainder of your career, or for as long as the S&P weighting looks essentially like a second-rate NASDAQ futures contract. And that is, if you're not willing to play the NASDAQ to the long or short side, you really should not be all that interested in the S&P. Or, better put, if there's not a buy in the NAS, there's not a buy in the S&P. Now this could change, and let me talk a little bit about when and why. This could change because what you want to remember is, if I'm looking at the S&P and if I'm looking at the NAS, obviously tech, consumer discretionary, healthcare. So unless there's something happening in financials, this is the XLF right here, unless there's something happening in financials, these are going to move together, all right? So that's why I say if there's not a trade in the S&P, probably not a trade in the NAS. Sorry, if there's not a trade in the NASDAQ, there's probably not a trade in the S&P. So NAS first, then S&P. And that was what we were looking for into the close. Now, what you'll see here, this little highlighted area that I have, these were two zones that we created with two tools that we use in our chat room every day. One is obviously the wave and the grab candles. They're color-coded candles here. These are grab, stands for green, red, and blue. Just an acronym for the colors, green, red, and blue. And the wave itself, which is the 34 EMA on the high, the close, and the low. All right, so you know exactly what these are. These are available free on many, many platforms. Thinkorswim, TradeStation, Ninja, TradingView. These are free tools. So these are my free tools. I've been using these tools for a lot of years, and they are often imitated, and I'm super flattered. Again, it's the 34 EMA. And you'll see there's three lines for it. Well, remember that there's a zone that we're looking for. So the zone is going to be then determined by a second tool. And the second tool is understanding the rhythm of the trading day. Now, this pullback was actually really well defined. It was defined by what's known as the HPMR tool, and that just stands for hourly price movement range. What's the typical price movement range? A market would see hour to hour, 3 to 4 o'clock, 2 to 3 o'clock, etc. We utilize that kind of historical repetitive type price movement, very different than a volatility analysis or an average true range, very different than that. And we utilize that kind of information to understand what kind of pullback could we see during this time of day. So what this does simultaneously is let you know that if there's going to be a really good entry, let the market pull back by a well-defined, identifiable amount. Let's see if it lands within the wave, and if and when it does, that is where we will look to get long. And that is exactly what we did in the chat room today. I walked a bunch of traders through that particular trade, and we waited and we waited. I mean, we had to distract ourselves to keep from doing something up in here, right? I'm distracting myself, and then boom, we get the opportunity. So I hope those are some guidelines and some things that get you thinking about how you're entering your trades. I'm not looking for higher highs to get into the market. I have to trust that healthy trends correct. And into the close, we use different times, kind of a 20-20-10-10 rule. I'll talk about that in the premium video to understand when we should look for our pullbacks, what time window, and then a little bit more detail on this trade and a number of others that we have open right now, including natural gas, which I think just hit our profit target. I'll see you in the next update.